Hello, my name is Susanne Wiegand. I'm the CEO of RENK, and I'm very pleased to present our company to you. Order intake developed favorably in comparison to the first half year this year, 2024 to 23. We could see that we were impacted last year by some big orders, which is very positive, but the base order intake grew nicely, which you see in the gray figures. On the Q2, we have made a huge step up overall by taking in a big order from the US in the second quarter this year and increasing significantly order intake and taking from the market, from the defense super cycle. On the revenue side, we are super proud that we have delivered a very strong first half year with a top line growth of more than 24%, driven obviously not just by a good Q1, but a very good quarter two with a top line growth in revenue of 26%. Fixed order backlog grew by more than 5%, so we were able to translate from soft order and frame order backlog into firm and signed contracts, which is great development with this very strong first half year. So this is also reflected in our gross profit development on the comparison in the first half, more than 17% growth. In quarter two, more than 10%. On the adjusted EBIT, we see also on the half-year side, 9.4% development on adjusted EBIT, very good. On the quarter two, we had base effect, a one-time base effect last year of 9 million. So if we take that out and neutralize that, very good development also on the adjusted EBIT side, and the net debt on a stable level with a leverage of 2.4, which we will midterm obviously will reduce down to 1.5. But all stable, very good performance on the first half year and quarter two. Let's have a brief look into the segments. The VMS segment developed very well in quarter two with respect to the strong order intake, and specifically thanks to the big order we could take in from the US Army. On the revenue side, very pleased to see great development with almost 21% half-year comparison and 19.8% on the Q2 comparison. With respect to the adjusted EBIT, we see here in the half-year figures as well as in Q2 the one-time base effect of last year. So taking that out, development on a moderate stable basis. We have to improve a little bit in the operational efficiency on the US side, which we are working on. So we expect in the next quarters to come a significant improvement. On the M&I side, very, very favorable development. We are very proud that we could increase order intake as well as revenue very strongly here on the half year and on the quarter with more than 50%. And also, as you can see here on the adjusted EBIT side, very strong performance of the M&I segment thanks to a very strong Navy business in the segment and also a very good aftermarket performance. Slide bearings, absolutely stable, well-performing business. On the order intake side, almost 9% growth in the half year in comparison. Revenue grew, as you can see here, for the quarter by 12.3%. Very strong Q2, and also with respect to the EBIT performance with 19% EBIT margin in Q2, definitely delivering even above RENK Group level. So we are very, very proud. Also, first half year was very strong already with an adjusted EBIT margin of 18% and an overall development of improvement of more than 40% ramp up on the EBIT side. With respect to our basic adjustments, was to mention is obviously the largest effect is our PPA adjustments due to the acquisitions, the acquisition of RENK by Triton, and also the acquisition of the US business, the dominant factors in the PPA. We had some capital market readiness costs, which we have adjusted over time and which are phasing out obviously in the next quarters to come, since once this exercise is over. We have some other adjustments where we have at the moment measures for improvement in the US activities incorporated. There are no major other adjustments to be mentioned, which we think is a fair and straightforward approach. Net working capital, we touched that also. Net working capital development is at the moment, according to our ambition, a little bit too high. So our midterm target is to bring it down via 25, 23 into the 20% area midterm. Please, the level of prepayments received. We're working on a specific measures with respect to the inventories, which we need to bring down over the midterm quarter into the area as just mentioned, over 25%, 23 into the 20 percentage area midterm. Key cash flow items was worth to mention that some tax payments in 2023, including an aperiodic real estate tax payment. What we can see also here in the quarter two this year was simply working capital cash outflow on a higher level, the 34.8 million, reflecting higher revenue levels. We had a rather low capex in Q2 this year on the level of 1.8% of sales, which is reflecting that we are in total well invested and serve well with our 3% capex assumption. We have some major effects in the first half year due to refinancing from the high yield bond into our new term loan B, new financing arrangements which we have done in the frame and in front of the IPO, which is one-time base effect of 34.6 million. And the specific interest payment, which then came in quarter two this year, also driven by refinancing of the company and the prepayment penalties of the bond, which came with the refinancing. So other than that, basically positive cash flow. If we neutralize those one-time base effects, we are rather pleased with the development. Guidance, I think this is also to finalize our presentation. We achieved guidance on revenue and EBIT last year for the known figures. We raised the guidance based on the performance of the first half year this year. For 2024, we end up on the revenue side on the upper end of our guidance with 1.1 billion. And on the revenue side and on the adjusted EBIT side, we narrowed the guidance also to the upper end, 275 million to 190 million. So in that range, we feel comfortable and are very glad of the performance of the first half year, which allowed us to raise and narrow the guidance for this year accordingly. With respect to the midterm targets, we have raised the top line growth from an annual CAGR for organic growth 10% to 15% on the revenue side, and on the EBIT side we raised the target from 250 million midterm to 300 million. So overall, very strong performance with respect to our key financial indicators this year. Very pleased with the development of the company and looking forward to deliver the next quarters and good results for our investors and for our employees. Thank you very much.
Disclaimer. As described in the legal section on our website, c11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.